Well, hello, Alliance family. Welcome to the Thursday product training call. This is Gina Hawks, product specialist with the Alliance. And I see we've got lots of people still logging into the webinar, but don't want to delay it any longer. I know we've got a lot of great information to share with you today. And we have Jim Mosley that's going to be on the call with us today. And Jim is going to go over some information on the FlexLife product. So as you are aware, as you've seen a lot of announcements coming out from us here at the Alliance and as from the insurance carriers as well, we've had lots of product changes and continue to have some product changes before the end of the year. So I wanted to make sure that everyone was kind of on board, because I know we've got a lot of people out there that are using National Life Group for these awesome IUL products that they have and helping your clients save for retirement. And the FlexLife is one of the products that has changed a little bit. We used to sell the FlexLife 2, and that has now been changed over to the FlexLife. Drop the 2. So the product that you're going to be using now is the FlexLife product. And Jim is going to go through some information on the product and kind of what changed and things like that. But again, just want to make sure that everyone is aware of the new product and kind of the changes and just up to speed on the product. So I don't want to take any more of Jim's time. I know he is crazy busy working with us as well as other people that he works with. So Jim, I definitely appreciate you taking some time to spend with us today, and I am going to turn it over to you.
Thanks, Gina. I appreciate it. Hello, Alliance family. Thanks for letting me come to you live this afternoon. Hope you guys are doing well, staying busy as holidays are approaching. It's a fun time of year. Certainly make sure you do take some time off at the end to spend with family and loved ones, but I also know it's a good time of year to finish up and wrap up business. Also some contests that are currently wrapping up. So for those of you that are doing Final Push for Alaska, I wish you well with that. Let me know if there's something I can do to help out. Certainly some IUL premium could help you get over the top. We would love to see you there. As well as the National Life Contest as well. We've got that still running through the end of this month as well. Make sure that you get a couple IULs in-house so we can get you a polo. I wouldn't stop there though. Get at least 5 total apps. That can be life, annuity, any combination. Make sure you get at least 5 apps in-house. That way you can qualify for the raffle. And for those of you super high performers that don't like leaving anything to luck, just make sure you're #1 in premium so you can win the $1,000 top prize and not have to bank on those raffle tickets for the smaller prizes. So, but with that in mind, I do want to chat with about you the new FlexLife product. To Gina's point, I'm sure you guys are getting flooded with bunches of new products. Kind of, this is an industry-wide scope. So really, all of your carriers are in the middle of bringing out new products to the updated mortality table. So we all use the same tables, and then actuary looks at pricing to figure out, okay, what's a good product that will make money for the insurance carrier, right? Because we are a for-profit company, as you've heard Andy talk about. But we also want it to be a really good product for the client, or else no one's going to want to buy. And we also want to make sure that we can pay you guys comp, or else no one's going to sell it for us. The nice thing is that on the whole, the FlexLife product is going to be, in most every case, a better fit for the client. Most every case has increased in mortality, which has actually caused prices to drop. So virtually across the board, you'll see it end up being a better fit for the client. I said costs on the list. It costs less. There is a difference between cost and premium. Again, you guys all know this. IULs work best when we overfund them. Specifically, you guys do it really well when you're trying to build cash for the client at retirement. So we're not necessarily going to be changing the premium per se, but in most every case, the true cost of the insurance is gone down, right? So it should be a pretty easy story to sell. So hopefully you guys had seen some of the announcements that we were going to stop taking apps on the Flex 2 and try to do a smooth transition. Reason being is that we by law cannot issue a FlexLife 2 on January 1st. So that's why you'll see, for those of you guys that still have some Flex 2 stuff that's pending, you'll see us checking in, doing everything we can to make sure we get all that in up front, because if it's not issued by year end, you're going to have to do a whole new application, and we certainly don't want to cause that. So please be responsive to myself or to Casey, anyone that's reaching out to help you make sure we clear that business for the end of the year. Also make sure that you guys have a good Christmas from a comp standpoint. Here's the new FlexLife brochure. I did want you guys to see that, so we did update that with the new product to get rid of the 2. It's pretty similar to the past brochure, although we did change that cover page. So you should be able to tell if you have one of the old ones versus one of the new ones. So that's pretty cool there. One thing that I'll draw your attention to is that the new product does have, there's a couple new things about it that I really like. So first, and this is actually probably one that you haven't heard me speak on before, not because it's not cool, but because honestly, it sometimes is a little too far into the weeds, and so I usually don't like to go there, but it is cool for you guys to know moving forward. So all of our IULs, Peak Life, FlexLife, even the past products, Flex 2 had this as well. We have something called an accumulated value enhancement. This is basically a bonus on the policy. Best way to describe it is a persistency bonus. We want to reward clients for doing business with NLG long term, right? Most carriers, it takes a longer time for us to start being profitable on our policies, and so when we reach that time, we want to reward that client. The cool part about the new the accumulated value enhancement on the new FlexLife is it's actually a bigger enhancement, and it starts sooner, which is kind of cool. So you're now going to get an extra 10% of what got credited in that segment, up to 0.75% of the value starting to that segment. Again, you're catching quickly of why I don't normally talk about this on stage. Sometimes it's a little too far into the weeds. But basically, it's extra cash that gets credited to the client. It's a totally free rider. There's nothing they have to do to opt in it or anything. And now in the FlexLife, it starts in year 6. Before I think it started in year 10 or year 11. So a little bit sooner there. So definitely, again, we're trying to get to continue to be one of the best IUL products that are out there, as a lot of other companies are starting to step up. I've certainly noticed an increase in living benefits as a whole. We continue to want to be one of the top ones that you guys have access to. So we're always looking at ways we can make it a better bang for the client's buck. The other part that I'll draw your attention to, again, this one's a little less into the weeds, but you still probably haven't heard me talk about it super often, is we did come out with a couple of new indexing strategies. I will pause here to make the plug. If you haven't seen Gina talk about interest crediting strategies, you should certainly start there. I think she is one of the best, not only within Alliance, but within all of my groups. She has one of the best presentations that really simplifies indexing from a client perspective, right? 0 is your hero. We can't go down, but we are getting upside potential. I do really like that story. However, there is one of the new indices that changes that to where 0 is not your hero, but actually 1% can be your hero. So we do have on the new FlexLife, there is an S&P 500 point to point that has a 1% floor. So it's not every strategy, but if the client, maybe they're a little bit more risk averse, they really like the idea of knowing they're getting at least some growth every year, kind of a cool strategy. It's a little bit lower cap than the 0 floor. That's the trade-off. Hopefully you've seen Gina do her arrows. But again, it's kind of a cool option for the client that wants to have that. For those of you that are or wanting to get more into the multicultural space, we did introduce the Hang Seng Index. The Hang Seng is a very well known. It's out of Hong Kong, but very much has some of the biggest companies that are out there. So if you're looking for some international exposure, that one could be a good one as well. Certainly if you're working within the Mandarin or Chinese markets. And then this Credit Suisse volatility one as well. So I don't really like the name here. Don't be thrown off by the 5%. That 5% has nothing to do with a floor or a cap. It's really talking about volatility. So if you guys all think about the market, so whenever I think about the market, I now think about Chris Norris because we've traveled together so often. So think about Chris Market talking about markets going up and down, right? Traditionally, the last 20 years, the S&P has averaged about 20% volatility. whereas this Credit Suisse index is targeting volatility of 5%. So it should be both stable on either side, meaning the high shouldn't be quite as high as the market, which isn't great, but certainly the nice part about it is the lows won't be as low as the market. And so you're really targeting kind of this stable growth. So that was a cool strategy from that perspective. Because it's a lower volatility, we actually don't have a cap on that product. So from a marketing sense, that sounds really cool. Don't get super thrown off. You're not going to necessarily see returns of 30% because, again, they're targeting less volatility. And generally speaking, the less risk you're taking, the less reward you can be getting, right? So you guys have seen Chris talk about, hey, people are saying, hey, my stock account's great. I'm up 20%. That's taking a lot of risk to be able to earn 20%. So again, kind of more into the weeds here out of the gate, but it is some cool things for you guys to be aware of on the new products. Certainly very competitive, and depending on what your client's risk tolerance is, there probably is one that's a better fit for them. I will echo Chris Norris's point. It's hard to time the market, so the longer you look back on all of these, the closer they are to all be the same. So I would really focus in on what the client, what the client's risk tolerance is, how they feel about the market. Let that really kind of guide your principal on which one might be the best fit for that client. So here we are back on the main home page. So this is what you'll see when you first log into our portal. I know you guys have been getting a lot more familiar with this. It certainly helps as you have more cases to be able to check on the dashboard. Dashboard is a great place where you can go to check pending status. I know we were having some issues before where you guys would send in requirements and for whatever reason they wouldn't show up on this. I think we've gotten most of those resolved. So certainly this is my opportunity to let you guys give feedback to me as you see stuff not showing up on the website or documents not being uploaded. Please let me know. We are doing a better job of getting those updated pretty quickly. Now that doesn't necessarily mean cycle times are getting shorter, at least yet. So that normal turnaround process from EAP submitted all the way to issue on the IUL side is about 5 to 6 business days. Again, just because we are doing full underwriting. We're not doing paramed, which is a good thing. We're trying to make it as short as possible, but compared to if you're used to a truly simplified, non-med, not fully underwritten, then obviously 5 and 6 days sounds like a long time. To date myself, I know Chris has some funny stories that shows his age. A funny one from my age is when I first got in the industry, the company that I was with always did full paramed, and actually usually it would take about a month for me to know whether or not my client got approved. So we certainly are moving away from that, but let us know if you're having any issues on the website. Most of your time, if you're not checking on a case, most of your time is actually going to be spent here on the left-hand side. Here's our illustrations. Enforce, if you wanted to run an Enforce one before an annual review, is there. The iGo EAP is here as well, although I always launch it from my illustration software to cut down on that EAP process. And then my forms and marketing, if I need to order any marketing materials, is there as well. One shout out, and I bring this up specifically. I know a lot of you guys were in Austin a little over a month ago doing an annuity class. I know in general, y'all's annuity business is certainly picking up. So one thing I just want to avert your attention to make sure we don't have any issues. Most states require carriers to have a carrier-specific product training on the annuity side. So this is different from some states. I know Texas is notorious, actually has an actual continuing ed class that you have to take before you do annuities. In addition, there is carrier-specific training. And so I want you guys to know where ours is because it doesn't take long at all, which actually makes you more upset if you submitted a case before you do it because you'll have to redate the app. So to find the annuity product training on National Life, you see our 6 tabs here. You're going to just scroll over training and product, right? Because again, we're doing product training. And then you're simply going to click on annuity right there. So training, product, annuity. And then when our next page loads up, we'll click on annuity products training. So products training right here, the very last one. And then when I click on that, it's going to give me a few different options to read through. And then there's a spot to check, saying, hey, I have read through all 4 of these. I will give you a little disclaimer and hint. Most all of you guys are going to be selling our indexed annuity products. So this one's certainly the one to pay the closest attention to. These other ones are here. If you are variable or securities licensed, you can look at that one, but this is really where you're going to be spending the most of your time. But make sure you click through these and check this box, and then click submit. Apparently I've already done mine, so it's not letting me recheck it. But make sure you check that and click submit before you do any annuity apps, just to save time and grief. So sorry a little bit about that rabbit hole, but I do know as we're always looking for business, whether that be life or annuity, I don't want you guys to get tripped up on that. So anyway, let's go back to the main website. So I do want to show briefly some illustrations talking about our living benefits and how you can utilize those. So we go on here on our illustrations tab. Luckily, the illustration software has not really changed with the new product, which is good. We did update a cover page on page 1 that I think does look a little nice and neat. So I will show you guys that as well in terms of making it. But here is what it would look like as you go in on your dashboard, right, as an agent. So you'll actually even see you have the IGO EAP button here. For those of you that have had to endure me presenting before, you might have heard this, but for the new ones, hopefully this will help you feel more comfortable with my illustration software. Up here on the top right, we have a show alerts. Sometimes there won't be anything up there. Sometimes you'll have a red X, and sometimes you'll kind of have this yellow caution sign. So for those of you that met me, again, the joke I'll always say is I'm from Texas, meaning when I see a yellow stoplight, that does not mean slow down. It means speed up and push through. So if you see red here, it means you have an issue. Yellow just means that we might not be complete yet. In fact, the yellow here is resolving around actually client data. But if you'll notice, if you actually put in real client data, so real name, and then the system will default to today's birthday for an age 45-year-old, right? So as you go in and say, okay, as you do a different date, and Chris, forgive me because I'm shooting from the hip, although I'll be kind. So as you go in here and plug in actual data, you'll see that your IGO EAP button turns green. So this will certainly help cut down on time it takes to do an EAP. I know a lot of you guys are doing those while you're there in the home. So I definitely want to make sure that we make those as easy as possible. Now, if you actually clicked on this button, it would transport it over to this EAP, and it would actually pre-fill everything that you've already done. So it would give you your monthly premium. It would give you the face amount. It would give, Chris Norris date of birth and rate class. So it definitely does help cut the timing down of the EAP. And then for those of you that haven't seen our EAP before, you'll see this last tab that at least I'm showing right now. Our EAP is split into 2 pieces. And so I do want you guys to be aware of that. Really, your first one only, it'll seem very seamless. It'll be like, oh man, this app was super short in part 1 before you get to part 2. I know that can be confusing. The reason we have it's actually a good thing. So historically, if you were going down fully underwritten product, you might submit an EAP and maybe a week later you'd get an email from your case manager saying, hey, the client answered this question such and such a way. We actually need you to go fill out this, cardiac questionnaire or clarify these 2 questions on the application, go back and see your client, drive all the way out, a couple hours to go see them. We're trying to eliminate that. And so what this part 1 validate and lock piece will do, probably won't let me on mine since I didn't fill the rest of it out. But when you go to part 1, that's basically signing the HIPAA. So you're signing the health disclosure, letting us check into the client. What that does is that means if the client does have any of those questions where we do need to do a questionnaire or we do need to clarify a couple of questions in the EAP, it's going to pop up right there in the EAP while you're still with the client. So just know that, yes, I understand it probably adds somewhere between 3 and 4 minutes and actually doing the e-app, but it's going to save you 3 or 4, maybe even more days from total submission to paid. And we all know that's the goal, right? So definitely bear with us on that. If you do have questions on your first one or so, give me a call, give our sales desk a call. We'll walk you through it. But most feedback has been very positive on that sense. So I know a few of you guys have already, been sitting in IULs for this contest. But if you haven't worked with us before, or you're one of your new carriers and giving us a try for this contest, certainly give us a buzz if there's anything we can help you. The more you spend time on this, the easier it will be to pick up and learn. So once we have Chris's data, we'll go over here to the death benefit and funding tab. This is where most of the fun part of the illustration will take place. My software is very advanced, which is good, although sometimes that can scare people and look too complex. What I would tell you is start with what you know for every case, right? So you guys know, certainly when you're doing the mortgage protection side, on the term side, typically you have a death benefit in mind, right? Hey, the client really needs $250,000 for the mortgage, right? So we could do a case that way. We would put in $250,000, and we would say, hey, what do we need to be paying in terms of target premium, or hey, if we want to max fund it for cash, hey, what could I do on my guideline level premium? Guideline level is probably my favorite. That is, what's the most I can do if I'm doing the same amount of premium every year, right? Most clients will want to pay the same amount. There certainly will be some times where they can do an increase later on, but if we set them up on guideline level and a level death benefit initially, then we will have some extra levers that we can pull to add more premium later. So that's how we do it. If it's a death benefit driven case, right? There's my 250 that we named, and then the computer said, hey Jim, if you want to max fund this, pay guideline, right? $33.76 a year. That ends up being about $281 per month, right? Pretty easy. However, I know that for most of you guys, when we're talking about life insurance from all the extra benefits, right? Not just death benefit, but when we're talking about living benefits, we're talking about chronic illness if a long-term care situation comes up. Or my favorite, as you guys see the puzzle piece, on our marketing or any of our illustrations, you'll see that everyone's favorite puzzle piece is the green, right? Again, my marketing department, I know they're always learning new things, but man, they got this idea spot on, right? We've got one product that covers all of these solutions, but from a color coordination perspective, everyone wants to be in the green, right? We all want to be making money. Of these 3 concerns, everyone hopes they fall in this camp, living too long, right? And so in that spirit, generally when we design these, we don't really care about the death benefit, right? We're usually designing it based on premium. So again, same thing, start with what you know. So if we know what our premium is going to be, we'll come down to the premium, we'll specify that amount. And let's just say in this one, we want to do, I don't know, $600 a month. Certainly could be more, could be less, but let's just say a client wants to be doing $600 a month. So we'll do 600. My from through is asking me how long I want to be doing that. So you could count out actual years if you wanted to do 20 years or 25 years. I always put the letter A and then specify the age I'm looking for. So this means I'm going to pay $600 a month from policy year 1 through the age of 65 in Chris's case. And then up here on my death benefit, I'm going to say I want the smallest death benefit possible to really maximize my cash value, right? So you'll notice here's what my net death benefit is going to be day 1. Notice that's kind of a random number, right? It's about 550, but it's a very specific number. The reason, again, being is I wasn't solving for 550. I want the smallest death benefit that lets me put in this $600 a month in premium. And then in this one, let's say we want to show income coming out on the back end at retirement. So if we wanted to do that, what we would do is we'd come down here to our distribution information section. Again, a few different options we can pick from. Solve for income is the variable loan option. A lot of you guys are probably familiar with this one. Most carriers in the IUL space have that ability. but that's going to be the variable income. The lifetime income benefit rider, that's that one that does a guaranteed income stream that we've talked about. That one's going to be the LIBOR. So I'm going to illustrate the LIBOR on this one. My note being is that no matter what we pick today, we're not locking Chris in this right now, right? Chris is going to decide this once he's 66 and ready to take money out. And so all that to say, figure out what works best for you to illustrate. Most of my agents, to be fair, don't show the client both. Most of them will just show one, but they might mention, hey, there's lots of ways we can take money out. We'll do what's best for you at retirement. Here's the guaranteed income. Or, hey, we have a few different options to pick from at retirement. We could do variable loans. We could do a guaranteed option. I'm going to show you today the variable one if you want to do that one. So just one of the things I've learned is sometimes less is more, unless you're working with an engineer, and then you're going to have to show them how the watch works. So here we see our same $600 a month of premium that we requested, doing about $7,200 per year. Again, the random death benefit that the system solved for me. And then at least right now in this one, we're showing Chris getting income of $23,500 a year, starting at age 66. So pretty powerful, again, especially when you look at the fact that this will be guaranteed at that time. Good question. I can't remember who asked me this last time, but the language that I would use when I'm showing the LIBOR is I would say there is going to be a guaranteed income stream when we reach retirement, but we don't know for sure what that's going to be, right? So if the client says, hey, is that 23.5? You guys guarantee me that 27 years from now? No, we're not, right? Because we don't know what your cash value will be at age 65. And then normally I would say, if you're telling me that you'd have $336,000 at the end of age 65, then yeah, we'll guarantee you 23.5. We just don't know if it'll be 336, right? It could be higher. We certainly hope it's higher. It could be lower. Again, our back testing, we're pretty conservative on our back testing and what we're showing. But that's the language that I would use, is there will be a guaranteed income stream. We just don't know what that's going to be until we reach retirement. So pretty cool on that one. I skipped over the riders and the interest rates, but we certainly can add those if we want. The nice thing about the riders, all the free ones are already marked here, which is pretty neat. So if you wanted to add one, you certainly could. Or if you wanted to change the ABR projection age, the client says, "Hey, I want to know what would be available in a terminal illness at age 68." Okay, you could just change that age, and it would show up in the full report. And then on the interest rate tab, just moving through, again, it's going to default normally to 100% in the S&P 500, the high cap option, but we can change those if we want to. Now the assumed rate is I mentioned our back testing earlier, so this is what we feel comfortable with illustrating. Jim, is the cap 6.03? No, it's higher than that. But we're going to be conservative in our illustrations. The thought, again, 170 some odd mutual company, our thought is, hey, we'd rather under promise and over deliver. So that's what we feel comfortable with illustrating. So if you said, hey, I want to do 6.5, we're going to say, hey, sorry, we don't feel comfortable with that. You certainly could, if you want to be even more conservative than a 170-year-old mutually owned insurance company, you certainly can. You could do 5.75, and it will run it that way. But the most is going to be 603. So I only say that I know sometimes you guys like to give we want to give the client the best product. So I know sometimes you'll show NLG versus some of your other options. Again, totally fine by that. If you're going to do an apples to apples comparison, a lot of times you're going to have to lower their interest rate to match ours, just because again we're not going to show more than 6.03. But again, very, very competitive product. We got some awesome living benefits. And at least at this point, I think we're still the only one that has that guaranteed income rider on the back end, which is pretty neat. So that is that. I did want to show you guys, just because I know a few of y'all had asked. Jim, you said, hey, this is how you would design it for optimum cash. What if that client wants to do more premium later on down the road, right? What would that look like? So we are paying guideline, which is the most we can do. If we're doing the same amount every year. But we're also still doing this on a level death benefit, right? 547, 547. So the nice thing is by starting off on level A, at least in this scenario, if the client did, we are max funding, right? You'll see here on death benefit funding, I did say max, right? So we are max funding for cash, but since I'm doing a level option A, there is some flexibility here. I'll show you what I mean by that. So let's say the client is initially going to do that 547, 698 death benefit, but let's say they get a raise in, let's say in year 5, they get a raise, and they want to put more money in this policy, right? Well, we were max funding it before while we were doing a level death benefit, but if we call home office and say, and your client could do this whenever they want, well, client could do this after the first anniversary, excuse me. Gotta wait 1 full year before we can change our death benefit option. But the client could call us in year 5 and say, hey, I want to have an increasing death benefit at this point, pay more premium. So what that would look like if we did that, so we're going to pay that $600 a month in the first 4 years. And again, the client might not necessarily go this high. I just want to see with how high they could do. 5 to age 65 is there. And they come here. So let's go to quick view and see, okay, this is for the client that got a raise, they wanted to increase their premium. What would that look like? So on here, we're still paying that $600 initially, but when we pick up the phone and change it to an increasing death benefit, it looks like we could end up doing an extra $10,000 a year in this plan. Again, we don't necessarily have to do that, but we could. So again, probably not going to show this, at least in that first initial meeting. I wouldn't. It's going to be too confusing. But for those of you that said, "Hey Jim, how are you able to add more premium later on when you're still max funding it out of the gate?" This is how we would do that. So. So that would be that illustration here. Again, if the client never ends up pulling the trigger and doing more premium, that's totally fine. We still have a really good policy here at retirement, which is pretty neat. So that looks pretty good on that end. We could launch the e-app from here. Again, the e-app runs through pretty quick on that end. Yeah, I wanted to see what questions you guys had, although the other thing that I did want to talk through, and I might have to change mics here. My mic is starting to let me know it's getting a little bit low on battery. But one of the other things that I wanted to talk through with you guys was prospecting. So I know you guys do a really good job of always looking for prospecting. I know a lot of you guys will use some lead systems as well. So in addition to what you already have in place, something that I've been seeing some of my agents have a lot of success with and getting even more prospects is to ask good questions when you're in that meeting with the client. So what I mean by that is you guys do your emergency contact list, and that's a great idea as well. But when you're talking with the client about retirement, Mr. and Mrs. Prospect, what do you want retirement to look like later on down the road? If you can ask good probing questions in terms of who they're spending time with, that's a good intro in terms of who you want to get referred to. And so if I were to ask you to brainstorm, hey, what's the ideal client look like or the ideal prospect look like in terms of getting referred? You might say, oh, well, they're a business owner, or maybe they're a doctor or a lawyer. They make really good money. And not that those things are necessarily bad, but a lot of times from the prospecting side, the best prospect is going to be somebody that you have credibility with because of your referral source, right? Meaning if I really like Chris Norris, and I think the world of Chris Norris, if somebody calls me and says, hey, Jim, Chris Norris gave me your name and number, thought that you'd be a good guy for us to connect with, then that's someone I'm going to sit down and listen to, right? We're borrowing that credibility that we have with Chris. And so the best way to do that while you're fact-finding with the client is asking for the referral before you get to the, hey, I'm asking for referrals stage. So if you're talking about retirement and brainstorming with them, hey, we're talking about retirement, Chris, what do you want that to look like? Who would be the 3 guys that you'd be golfing with on the golf course, right? Go ahead and jot those 3 names down when they answer, because again, those are people that person's close with, therefore it's probably going to be a good referral, right? Who knows where they're at? They might already be taken care of, or or maybe Terry Edwards already has them as a client. You never know. But those are, again, some good questions to be asking during that process. Maybe you can turn that one lead that you paid for into 3 or 4 leads, right? So I certainly wanted to make sure that I use that for you as well. Great question came in from Alex. Alex, thank you for asking that. So one of the questions that came in was, what's a good kind of general age where the tax-free retirement concept's no longer going to work, right? And I love the question. There's certainly, what I've seen is that most people's need for insurance never really goes away. However, there are some times where that death benefit can be reallocated. And so what I mean by that is, so I'll take my parents, for example. They're a little bit older. Their terms are
Jim, we lost you. I think your headset died. Hopefully you can hear me, but just to let you know, we cannot hear you. And while Jim is changing out his headset, and I wanted to kind of, yeah, he's switching his mic now. I did also want to talk to Alex's question about a general upper age. And again, we're talking about using this product to save for retirement. Obviously, if you've got someone that's older that's looking for life insurance, you know, then it's not as much of a concern for the age. This goes all the way up to, I think, 80 or 85 if they're looking for life insurance. Now, if they're looking for it for tax-free retirement, typically we will say about age 50 and above. But again, it's more of a time thing than an age thing. I don't really like to give an age out because then people think, okay, well, you know, they're over 50, this won't work. That's not true. It's more that they need about 10 to 20 years to let it set and grow before they need to take money out. So if you'll think more on time periods versus ages, if they're, you know, 50 and in really good health and they can wait 15 to 20 years, it could work for them for tax-free retirement. And Alex said, yeah, his rule of thumb is 15 years. I think 10 years is pushing it. They're going to have to put a lot of money into it for 10 years to work. So I agree with Alex. I think 15 to 20 years is, you know, more what you're looking for. So it's a time thing. Excuse me. It's also a health thing. If you've got a 50-year-old that maybe they've got 20 years before they want to retire, but they're in terrible health, then an annuity is probably going to be a better idea for them.
Absolutely.
So just keep those two things in mind. Time and health is really going to matter, both of which are relative, but the time, you know, think 15 to 20 years. And Jim, I'll let you continue to comment.
Yeah, no, thanks, Gina. Thanks for picking it up while I switch my mic out real fast. Yeah, Alex's point is spot on. It's going to be more more time horizon oriented as opposed to age. So in this one, again, just showing you guys what that could look like. I guess this one's about a 12-year horizon. And specifically because we're trying to keep costs down, I even started on increasing option B to give an even smaller death benefit right out of the gate. Now, granted, that does cut down target by going increasing, but that's all right. But you'll see even in this one, the client's getting a little bit less coming out than what they put in. Now, granted, they only put it in for 13 years, right? Whereas we're showing them getting it out, you know, potentially all the way to 120. But yeah, same principle applies. It's going to be more time-based as opposed to health-based. And in fact, actually, I want to. So even if he wasn't standard, even if it came back at, let's say, it came back at elite, that's going to be buying more death benefit because it's elite. You'll notice it's a little bit better income, right? About $800 or so. But I show you this to say that of those two, health is certainly important, but time is the most important factor over health. right? Even the guy that's elite versus standard, he's only getting a little bit extra income coming out on the back end. So yeah, generally, I think 15 is a pretty good rule of thumb. But yeah, either as long as they have both, it certainly should work. Again, in this one, it's a little bit less than 15 years, but it could be okay, again, depending on the client's goals and if there is a need for at least some death benefit, right? If they say, hey, I don't have any kids, I don't have anything to give any death benefit behind. Okay, well, maybe this one might not be the best fit. We might look at an annuity for income. Yeah, good question. In terms of the minimum, is there a minimum amount from a monthly contribution perspective? So there isn't per se, depending on the way we set up each death benefit. Every death benefit is going to have a minimum premium. So in this case, if you're doing the 129, the death benefit, the minimum premium associated with that is $17.14 per year. Now, the minimum premium every year the client gets older, that also means they're getting closer to life expectancy. So costs are slowly increasing. So I certainly would never start off anyone at the minimum premium. That's just asking for bad things to happen. You really want to be starting on the other end, max funding it. But yeah, there is a minimum premium there, but not from a policy perspective of the client always has to be doing at least, $25 to get started or whatnot. It's really going to be based on the death benefit. So that's a good question. And then Alex had another good follow-up. The illustration that comes with the policy is straight. Yeah, great question. So Alex was asking, the illustration that typically is going to come with the policy, is that a straight illustration, meaning they're not going to show any changes, between option A or option B, or showing retirement on the back end? And it's a great question. The answer is kind of yes and no, a vague answer. So typically it would be, Alex. So typically whatever we're showing in year one on the illustration is what new business will send out to the client. So in this case, we'd send out increasing all the way through and showing the 7,200 of premium all the way through. Now, I say that if we do our EAP, and if you launch the EAP from here, like I'm suggesting, which I certainly would, if you save this case first, then that's going to put the case data in NLG's home office, meaning we won't have to do, Alex, you call it a straight illustration. I usually call it a batch illustration. We wouldn't have to do a batch illustration. We can be more specific. So what I mean by that is, if you'll notice, when I clicked run report, this report came up. Hey, I'm the agent. Here's Chris, my client. However, it's just a normal illustration. I haven't saved it, and the reason I can tell that is that there's just page numbers here. Watch what happens though when I save this case into my system. So when we save this case in, so Norris sample. Now watch here in top left, my green text that used to say untitled, now it says Norris sample, right? And now when I actually run my report, you'll see on the bottom right beneath the page number, there's actually a unique illustration ID code. So again, before it was just page 1 of 27, right? Now it shows illustration ID 69510, meaning that if we submit from EAP now that we have that number in here, EAP will see and say, oh, okay, well, in this one, they were doing $7,200 a year. They were starting it off on option B, increasing, but leveling it at age 66 and showing money thereafter at 66. So if they have that ID number, then they can actually send this illustration as part of the policy to the client. So yeah, it really is pretty cool. And if that's not a reason to learn the illustration software on your own and be able to send it in like that, then I don't know what will. The reason Alex is asking that is if you get just the normal batch illustration at delivery, and it shows this $7,200 a year premium all years all the way to 120, and it doesn't show any income coming out, well, this is what you showed the client. You're going to have to resell this case all over again, right? It's going to take a lot of extra time. So yeah, definitely make sure you use EAP. Make sure you save your cases ahead of time, so that new business can see that unique ID. They will make your life much easier on the back end at delivery. And the reason that that's important from the delivery standpoint is, one, we want to make sure you guys get paid, obviously, but two, delivery is one of the best time to get those referrals that we were just talking about, right? They've already bought from you. They at least like you somewhat, right? Because they bought from you. It'd be a cool, a good way to get some extra folks to go look at and have a conversation with. So again, that's one part on the referral piece. The other thing, and you guys have probably heard either me, myself, or Duncan talk about this before with you guys, but one of the nice things about having this multi-pronged solution where it's not just death benefit, although again there's some good benefits to have there, but by having the becoming ill or the living too long, your potential prospect pool is increasing by the second, right? What I mean by that is, so now, think of your clients that already have term coverage, right? So they have good term, it's taking care of that death benefit, but as we now look at, well, hey, what will they do if they live too long, if they become ill? If they don't have other adequate resources, they might be in trouble. That's setting you up to help with a term conversion, right? You could look at seeing if, hey, Jim, we already have our term with whoever, we want to see if the client qualifies for permanent. Hey, it's a great avenue. Or, before, where you're working with folks that have only just recently bought a house. Well, now for those folks that might even still be renting an apartment, but they know they need to be saving long-term for their own retirement, maybe because they're trying to get out of, their student debt. They're graduating college with a bunch of debt. Hey, this is an avenue for them, even at that young age. In fact, it's actually better because their costs are so low. Or on the becoming ill side, this one's really cool. So on the becoming ill, this opens up, in terms of finding the money and finding the premium, this opens up, okay, well, what about those folks that have a cafeteria plan at their work, right? Or they say, oh, well, I'm paying, $5 a month for a cancer policy, right? And they'll have it as long as they're at that company, which, by the way, that will stop when they leave the company or retire, and it only pays out if they have cancer. Well, hey, why not? In terms of finding the money that we can fund an IUL with, hey, why not put that extra $5 that you may or may not use in just this puzzle piece and put it in something that will cover the whole pie? So again, by having all three of these as your approach, it definitely gives you, the agent, some flexibility to really meet the client where they're at, but help them see the value in this thing of, they're going to get their money back on this thing one way or the other, right? We certainly hope it's not the purple puzzle piece, right? But we know either way, all those premium dollars are going to be coming back, and hopefully some more, right? Depending on, when they retire and how long they can be taking loans out. So a good question came in terms of health stuff. So either on the policy or even on the living benefits piece. So let's say the client gets offered coverage, but they declined on one of the illnesses, one of the ABRs. Is that something that they could potentially reapply for later if their health changes? So yes, it could. Typically on the living benefit side, it usually is harder to get those added on if we didn't get them up front, as opposed to, we might decline a case outright up front from an underwriting perspective, but we might be able to give the client coverage later on. But yeah, we certainly will take a look at it. I tell you guys this, as old of a company as we are, mutually owned, very conservative, the most liberal department in our entire company, in my opinion, is our underwriting department. And the reality is that's a good thing. That's the one area that I would really want them to be liberal. So they will do a good job of offering what they can. In fact, showing you guys an example, sometimes if you're in here and you put in a different rate class, so if you put in like an express standard rate class, then some of the riders will actually default to the no. So I can click this drop down arrow, but I can't click the drop down arrow on the chronic and the critical, because typically if they're getting that rated, we might lose those. I have seen much more recently as well, cases where the underwriter might come back with an express standard rate class, but they actually are going to give the critical illness or the critical injury rider. So they are being liberal where they can and trying to offer as much living benefits as they can. But yeah, it is someone you can look to get more later on. Another good question came in is of, hey, if they turn on the lifetime income benefit rider, could they end up taking a loan later on? They could. The reality is that they probably wouldn't want to, because what that lifetime income benefit does is it's going to give them that guaranteed income stream. And if we take anything else after that, or if let's say we decide to exercise a living benefit after we've already turned on the lifetime income benefit rider, then that would cease our lifetime income benefit rider. So we probably wouldn't want to do that. But if the client says, hey, I'm not totally sure which way I want to take money out at retirement, what you could do is you could solve for income, and then depending on what the variable loan is for that year, you could jump between the participating variable loan and the participating fixed loan. That way the client's getting interest earned either way, but the cost would be the cheaper. The fixed loan is going to be decided at issue, and it's not going to change. It's been at 5% ever since we've introduced the participating fixed loan. So chances are it's going to be 5%. It would be if you got a policy today. So what I would look is I'd look at the participating variable loan that year. If it's higher than 5, then do the participating fixed. If it's lower than 5, you could do the participating variable. But bear in mind that because of the NAIC, where we can only show 1% difference between these, so we're illustrating at 6.03. So if I'm going to show, so there's my fixed loan, my participating fixed loan. If I'm going to illustrate the participating variable, we're going to illustrate it today at 5.03, which is 1% less. But actually, currently, if you don't have any income right now, the variable loan is actually at 4. So again, the main thing on it, don't drive super down into the income conversation, you guys. Particularly, it's when we're going to decide, in this case, 20 years from now, talk about they have options, and we're going to decide the best option for them once they reach retirement age and are having this decision. So good question on that end. So I had a question come in about riders and some of the other options on riders, particularly one question about an additional individual insured rider. Personally, I would kind of shy away from that if I were you. There is one on the product. However, the additional insured, any of those other insured rider, additional insured riders, that's adding temporary term coverage that's going to get more expensive every single year. And so what I would say to that is if you're looking to have multiple people covered, then let's do individual policies on multiple people. That typically is going to be the better bang for the buck in terms of everyone has their own permanent insurance plan. If it is one, JC, that you're talking about from like an estate planning or something like that, reach out to Chris or to Gina or myself. We might look at some extenuating circumstances where it makes sense to maybe use the survivorship product or something like that. Typically, it's going to make more sense to have every person has their own policy. So certainly some good questions on that end. I changed my birthday back. That's why I was trying to figure out why my e-app ran away. All right, so there's my e-app. Now we can move forward with Chris there in the e-app. So other questions that come up, again, hopefully, yeah, the new FlexLife brochure is a fun one. For those of you guys that want to know a little bit more into the weeds in terms of how these things work, or if a client wants to know, hey, how exactly does the money come in? The brochure does a really good job of kind of walking through the money in terms of money coming in, and then it's sweeping into the index. I'm not going to dive into that today, just since we only have 5 more minutes. But the brochure does have a pretty good job of kind of showing through that. Again, make sure you ask that question of, do they want a hot dog or do they want to know what's in it? Most people don't want to know what's in a hot dog. They just want the hot dog. So, but yeah, definitely know we have the resources for you if you're working with an engineer or if there's someone that wants to dive a little bit more into the weeds. So, Gina, I think I got most of the ones coming in on the chat. Did you at least get any text messages on additional questions?
No, I don't have
Okay.
anything. Someone had asked about the difference between the accumulated value and the surrender value.
Okay.
Basically, the difference there, surrender value is the column that you want to talk about,
Mm-hmm.
because that's the cash they have access to. The difference between the two is only going to be different in the first 10 years because of surrender charges. So
Yep.
the accumulated value does not include the surrender charge, and the accumulated value is not what the client has access to. I kind of wish they wouldn't even show it on the illustration.
Yep. No, I understand that.
But that's the difference in the first 10 years is the surrender charge. Then you'll see that the two numbers are exactly the same
Mm-hmm.
until you start taking money out.
Yep.
And then when you start taking money out, the surrender value is going to start going down because you're taking money out, and the accumulated value does not ever go down. It just assumes it just accumulates, even when there's loans coming out.
Yep.
So that's
Yeah.
kind of the difference. Frankie had asked about that between those two, but I don't see any other questions in the chat or anything else that we.
Sure. No, that's a good question or a good point you bring up, Gina. So I won't hammer it too much, but you guys have probably some of you probably have already run into this, or if not, you might hear this from clients in terms of something called like the infinite banking concept or the be your own banker concept. That concept, although typically in a whole life policy, which I'll save that announcement for Gina for another time when she's ready. But that concept in terms of infinite banking, be your own banker, is an idea where the client has the ability to take money out of their policy, but their cash is still growing. And IULs work like that too. And so when you look, down to Gina's point, after the 10 years, those values are the same until we start taking money out. And when you start taking money out, again, the cash surrender value is what they have access to if they leave. And the reason that that's going down is because obviously they're taking a little bit of money out. But the key thing is accumulated value is what's actually there in their policy. Meaning even at this stage at age 67 and the client's not paying any more premium, and in fact now they're taking money out, there's still 614 that's in that policy potentially getting up to that cap of interest getting credited to it. So that's, again, it's very similar concept. I know that concept's normally in the whole life space, but it works in the IUL space from a hey, you can take money out at retirement and you're still earning interest on it as if it was there. So that's the only reason I like the accumulated value. But yeah, to Gina's point, it certainly usually creates more questions than it helps. So surrender value is the, hey, what do they have immediate access to, is a good way to think about that. So, well, Gina, if you don't have any other questions that have come in on your end, I will certainly do another shout out friendly reminder for those of you that are in the contest game. I appreciate that business and wish you well. Keep it up. A little bit over half of a month left to make those final pushes. A lot of you guys are texting me saying you're going to be number one. So I'm not going to put anybody on the spot, but know that if you're planning on being number one, there's some competition there. So certainly make sure you get in those life and annuity apps, and definitely reach out to myself, Lindsay, or our sales desk. I guess that's a good. I'll shoot it out to everybody just in terms of contact info. So my number is 214-638-9242. And then my email is jmosley@nationallife.com. And then the sales desk number, I'll send that one out as well, is 800-906-3310. So definitely reach out to us. Gina's awesome. Reach out to her, but I know there's only one of her. So if it's something specific on National Life related, definitely give us a call. anything we can do to help you guys close the business, we definitely want to continue partnering with you guys into the new year.
Yeah, thank you very much, Jim. I know you have been a great resource. I know you've done Zoom calls and gone to hotspots and been on a lot of our different managers' calls, helping to explain all the great NLG products. So we definitely appreciate that. And everybody, thanks for tuning in. Our time is up, but I do want to just remind you, if you've not gotten your national convention tickets, get in contact with your agency manager ASAP to get those. I know Jim is going to be there representing National Life Group, and so it's a great place not only to get a lot of good association and a lot of great information that's going to help you to grow your business for the next year, but it's also a great place to meet our carrier reps and get to talk to them and get to know them. So definitely, it's like I said, if you've not gotten your ticket yet, talk to your agency manager and get your ticket for National Convention in January. Jim, thank you again very much. And thanks everybody for tuning in. And we'll talk to you guys later. Have a great rest of your week.
Thanks, guys. Finish the week strong.